Hello everybody, it's Greg again, and this is the third part of a three-part video course on my class, The Thrift Savings Plan Made Simple with Greg Mesa. So guys, this is a class I've been shooting. This is the third and last video, and I want to wrap up some of the things that we have not covered yet that are important for you to make your decisions in your TSP. And going back, just a quick review of those things. I think there's three major decisions that you need to make, and that's why I broke it up into three videos. And when you're managing your thrift savings plan or your 401k is really what it is. So guys, the first decision, which we covered in the first part, was dollars. How much money in terms of dollars you can put into the TSP, how much money is being matched, and so how those dollars make a difference in your decision making. The second video, we dove a little deep on that one, is how do you want or when do you want those dollars to be taxed, right? Whether it be traditional, Roth, tax now, tax later. We covered that in video 2. And this third part, what I want to talk to you about is now that you have money in the account, now that you've decided how you want that money taxed, I want to talk to you about the different funds that you have that you can invest your money in. I'll go through all of them, try to go in a little bit of detail, because my goal is that you understand what you're buying when you invest in these funds. So, because guys, one of the most fundamental principles of investing is only investing in something that you understand, something that you can explain to somebody else. Okay? And the reason why that is the goal of investing and in the 401k is that you buy something that is an asset. There's something that is going to grow with time and is going to be productive, so that when you continue to contribute cash into that account, that money is working and growing, so that when you retire, your money has grown to the point where it can help sustain your cost of living expenses. Okay? And I'll talk more about that as we get in. Okay? So let's go ahead and get started here. Now guys, this slide shows you the five main funds within the thrift savings plan, and I'll go in depth into each one of them, right? And corresponding with these specific colors, you also have options to go into what is called our life cycle funds or our L funds. I'll talk more about these in a minute here, but first I want to go over these five fundamental funds that we choose, so that you can understand them a little bit better than when we started this video. And that when they are sliced up, and I refer to these as pizza pies, they're sliced up into these different pizza pies and these L funds, you understand why they're sliced the way they are and how these funds work. Okay? So let's start with each one of these funds, and we're going to start with the G fund. This one is very common. For those of you that are brand new employees, your situation as far as an automatic investment or default investment is different than some of us that have been in the federal government for a while. So we've been working, and if you want to contribute into the G fund, always think G for government. And what government? The United States federal government. When you purchase G fund in the thrift savings plan, what you're essentially buying is government treasury bonds. Right? You're giving money to the federal government so they could use it for different initiatives. And at the same time, the government will be paying you back a little bit of interest. Now, the goal, and I mentioned here, the goal of this fund is that you don't lose any money. So for those of you that your goal is really to save your money or a portion of your money, right? You don't want to take any risk as far as the market going up or down and any of that. This is the fund that you would put that money in, okay? So it is a very secure fund. It's guaranteed not to lose money. Now, what I would say here, it attempts to take your cash, and the growth you have is minimal, but it attempts to keep up with inflation. My argument would be, I don't think it does not keep up with inflation, because when you put your money in there, although you're not losing dollar amounts, you might be losing some buying power with those dollar amounts, okay? I'm shooting this video in December of 2022, and the last several months in our country, we've seen all kinds of inflation, everything from gasoline to food and travel expenses and so on. So again, your money in here, you will not lose dollar amounts. You will not lose any dollars in terms of dollar amounts. And that's the G fund. Okay? And guys, as I move forward and I talk about the C, the S, and the I funds and all of that, please remember, you do not have to dump all your money into one of these funds, right? You can come up with a combination of those funds, and I'll talk more about that as we go along, okay? So the next one, we start with the most conservative, and we go all the way to what is arguably the most aggressive. And you know, I'd make the argument that the C fund is not aggressive relative to other investments out there. I think it is a very moderate, and it's actually a very prudent investment where your money can grow. Okay, so when you think C, the way I remember C and kind of how it works, I think C for corporate. And when I say corporate, it's because it's compiled of the United States' 500 most powerful or influential companies. Okay, and so what you're doing right now is essentially buying, using industry terminology, buying an index fund or a mutual fund. And the way the C fund is compiled is you are buying, when you buy one share of the C fund, that one share is sliced up into 500 different slices. If you're thinking of a pizza pie with 500 slices, and you're buying fractional shares of stock in the United States' most powerful companies. Okay? Now, to better help you wrap your head around that, I want to show you a list and even a pie chart of those companies. And I think most employees, most Americans in general, we understand brand names, okay? So as you see this list, and I'll try to get out of your way here, you'll see a list all the way down to some very, very popular companies. So when you buy a share of the C fund, you are buying fractional shares of 500 companies. I won't go down the list as far as from the number 1 all the way down, and you see a lot of very popular ones here. Apple, Microsoft, Alphabet is Google, the Google company, Exxon, Home Depot, Tesla, Merck is in there, Pfizer, Bank of America, Thermo Fisher Scientific, Walmart, Abbott Labs. Guys, we're only on number 38, 39. So these are the 500 most powerful and influential companies. You got Cigna there, BlackRock, right? Citigroup, some of you bank with them, T-Mobile, some of them you use for data, PayPal, all kinds of companies. Waste Management, right? They pick up your trash. Estee Lauder for makeup, Sherwin-Williams for paint. Guys, we're only on number 140. There are 500 of these companies and we keep going down. I see Travelers Insurance there, Ford Motor Company. So you are buying, when you buy the C fund, you're buying fractional shares of every one of these companies, okay? And the reason why I favor the C fund is the C fund is a good instrument for you to buy. And again, you're investing in all these companies. So if you really think about that, every employee, every manager that works for these companies, they're coming into work every day to try and make more money for those companies, so those companies can sell more goods, more products and services, or buy more assets, like Amazon buying more warehouses, right? Or FedEx buying more delivery trucks, right? So, or these pharma companies doing more research and selling medication, Home Depot selling more paint and 2x4s. So these folks are coming in every day and they want to succeed. So you have these people working to increase the value of your investment, okay? And if you want to track it, I'll go back to my slide here. It tracks the S&P 500 index. Some of you have at least heard of the S&P 500. Some of you have heard but maybe not understand as well. But that's what the C fund is. You are buying fractional shares of all the companies in that list of 500 United States companies. Okay. As you can see, their returns, and I apologize, my returns are only back to 2021, but as you can see, the returns are a whole lot better than the G fund, right? So keep that in mind. So when you're buying C for corporate, big, the largest, most powerful, most influential companies in the United States, okay? Now, to kind of build on that, the next one is the S fund. And I want you to think S for small, but it actually what it means is small, medium companies. These are still publicly owned companies in the United States, right? Not overseas. And just because they're smaller or medium and they're not large like the S&P 500 or the C fund, that doesn't mean they're bad, right? If you think about it, small companies have the most room for growth, right? So your investment could also be very successful with them. You are buying fractional shares, right? Some stocks in those companies, and I'll show you a list, an example of those. But yeah, you're buying those small, medium companies. So if you think of I couldn't find a solid number, but I think American companies that you could buy stock in, I think there's around 10,500. And I've already told you the top 500 are in the C fund. Well, think of the remaining 10,000 are in the S fund. So when you buy a combination of the C and the S, you're buying every publicly owned traded company in the United States of America, right? So keep those things in mind, right? So that's the S fund. But remember, S does stand for small and medium United States companies, okay? So let me show you some brand names so maybe you can better understand what you're buying, because a lot of Americans, we understand brand names. So this is not an extensive list, but you might recognize some of these companies, Airbnb. Now Moderna, because of COVID, Moderna is now in the S&P 500. They have moved into the big leagues. So they're no longer considered a small or medium-sized company. They're now considered a large company. Snap's in there, NXP70, Dell Technologies. Most of us VA employees, we use Dell computers at work. Uber Technology, Uber's up and coming company. Square. A lot of us use Square to pay for goods at different stores and restaurants, right? So those are the companies in the S fund, right? And if you look at the returns, again, and that's why I say the C and the S fund, arguably, which one is more high performing than the other? They're both pretty high performing, right? So if you look at the returns, also some very good returns in the S fund. Now the next one is the same as the first two. And think I for international. When you buy the I fund, you are still buying stocks and companies. You're still buying fractional shares of a long list of companies. But now these companies are no longer in the United States. These are companies that are outside of the United States, right? So let me show you some of the countries. So these are some of the, when you buy the I fund, you're buying companies in these cities and states and countries all over the world, right? So you have companies that you're, very influential companies, very high performing companies all over Asia, all over Europe, South America. So you think about that, right? And these are just some of the countries. Now the companies, here's a short list of the top 10, right? So some of you might recognize Nestle, some of these other companies. Yes, Toyota is also still an international company, even though they have a very strong presence in the United States. AstraZeneca, Unilever. So again, international companies, okay? Now, one of the things that you might want to consider when you're thinking about putting money in the I fund, yes, you're investing in companies overseas. Some of those countries that I showed you, some of them have very large and fast-growing economies. They're doing really well. So you might want to consider that. At the same time, one of the things back in the 90s, back in the 80s, it was a very common belief is that when the economy goes up and down, right, goes through those cycles of up and down, that when America's economy goes up, the rest of the world goes down. And when America's economies go down, the rest of the international companies might go up. Well, one of the things that has changed over time is we're becoming more of a global network of companies, right? A global economy, a lot of trade going over the place. So if you look at the performance of international companies, United States companies over the last several years, we kind of follow each other, right? When we're successful, China's successful. When China's successful, Europe's successful, right? Or when one is suffering, the other one is suffering. So it's one of those things to consider. And I'll talk to you about how you can maybe diversify, meaning invest a little bit in everyone. But just so you know, guys, I think I for international. Okay. Now, the next one is the F fund. And the F fund is not stocks, rather it is bonds. Very similar to the G fund. The G fund was United States Treasury bonds. The F fund is also bonds, right? But as you can see here, the types of bonds are a little bit different. Now, there is some government debt in there, and that government debt could be local government selling bonds, your city, your states, and your counties, and so forth. Mortgage-backed debt, so you loaning people to give mortgage loans out to folks, and they're paying interest back. And same thing, corporate bonds. So you might have companies out there who want to sell a bond to people, right? So they can get some cash, so they can build new skyscrapers, build new factories, so on and so forth, so they could generate more products and services, right? So you're actually giving a loan and getting paid back a little bit of interest on that loan when you buy into the F fund, okay? These are some of the results over the last 5-10 years. You can see that. And technically the formal list of if you really want to dive deep into what type of companies or entities that you're loaning money to or you're buying bonds in, you could Google the Bloomberg's Barclays US Aggregate Index Bond Index, and that'll go a lot more detail. And that's what really the F fund reflects. This is a very fundamental class, so I'm not going to dive that deep into the funds, but I just want you to know the type of money that you're loaning out when you buy the F fund, and so you know where it's going. Okay, and that is the F fund. So, guys, that is, if I can go back to this slide, that is a summary of all these individual funds. Okay. Now, from here, I want to dive onto this side of the screen, and I want to talk to you about the L funds, or life cycle funds as they're known to be. As you can see, if you look at these, and by the way, if you didn't catch this, these numbers are actually years. They're the year that folks can anticipate to retire, right? So these and what they're really called is diversified portfolios, because they're made up of, pay attention to the colors here. If you look at the colors here, they're actually made up of larger and smaller slices of the different funds we just talked about, okay? But the way they're sliced up is really according to the year folks would anticipate to retire. So for example, let's say based on my age and my years of service, I'm anticipated to retire around 2043, right? Which will be right in here, okay? I might want to buy into a 2045 fund or a 2040 fund, depending on how aggressive or conservative I'd like to be at my comfort level, okay? And when you look at that, these portfolios, they're professionally designed by folks who analyze this stuff. And yes, if you're a person who wants to just set it, forget it, you want to have a variety of all these funds, you can buy into any one of these funds. Now, for my people, the newer people, the people that have been hired in the federal government in the last, I want to say 3 to 4 years, it could be longer, don't hold me to that. One of the automatic things they're doing for you now is they're automatically enrolling you into a 5% contribution into the thrift savings plan, and then automatically investing in that money into the L fund that is appropriate for your age and your projected retirement. I think this is outstanding. I think there are too many employees back in the day who had their money dumped into the G fund and was not making any progress. It was essentially the equivalent of burying your money in the sand, right? So now the newer folks, your money is actually being invested, it's actually working, and you could use one of these funds. Now, if you decide to put your money in one of these funds, one of the things you'll notice is, depending on how long you have between today and the year you plan to retire, the longer time span you have, the more aggressive the fund will be. And the closer you are to retirement, the more conservative the fund will be. Right? It is still designed to have some growth, and the reason why that is if you are about to retire, you don't want the money you're investing to be so aggressive, because if our economy hits a recession, hits a depression, or just even takes a really, in layman's terms, if our economy and the value of those funds goes down, you want to make sure that you have enough time to see those funds recover, okay? Now, one of the things, if I could take a time out, I would like to explain is, so guys, if you are new to investing and you are worried about the ups and downs of the stock market and the economy, one of the things that I need you to understand and you need to accept is that is the natural way of things, okay? The economy goes through cycles of up and down. The economy is going to go through cycles of panic, fear, or some people maybe over exuberance, or people are spending money like it's going out of style. If you've lived long enough, you're going to see those things happen in cycles. They're going to come, they're going to go, they're going to come, they're going to go, right? So when you invest in these L funds, it kind of modifies itself according to how much time you have left. I'll give you an example. If you are fairly young in your career and your money is automatically invested in one of these L funds, now down here, the 2055, 2060, these are pretty aggressive, right? There's a lot of green there. That's a lot of C fund, right? Corporate, big companies, good growth. I see a lot of purple in there. That's a lot of I fund. That's international companies. And I also see a good chunk of S fund, which is the small companies. So a lot of growth, right? And those people that are younger, the reason why it's so aggressive is because you have time. And by the way, if you are young, again, like I mentioned earlier, you need to have to accept you will go through. Anyone who's going to retire in around 2055 or 2060, it's not a matter of if a recession is going to hit. It is a matter of when. You will probably experience 2 or 3 recessions between now and the time you retire because of those market cycles. Okay? But the way these are designed, if you invest in these funds do something for you automatically. Every 3 months, if you invest in these funds, the way the pizza pie is sliced, it slowly over time adjusts every quarter, every 3 months to get more and more conservative. So that the closer you move to retirement, the more conservative your investment is going to be. And again, that's why I said, if you're a person who wants to set it and forget it, you might want to look into these. These might be a good option for you, right? So when you're young, they'll be aggressive. When you're halfway through your career, they're more on the moderate side. And when you're on the back end of your career, it really starts to get conservative so that you are not maybe having to work more time than you'd like to because the value of your stocks are down, okay? So those are the individual funds that we have. These are the life cycle funds and kind of how they match together. Now, you guys, you could do this. You could invest in individuals here, and you can even make up your own pizza pie. Like in my personal investment, me and my wife, I slice up our own pizza pie, and I go with what is age appropriate for us. Plus, also I look at how well we could handle the stress of an up and a down market, and that is really different between all of us. Okay. The next thing I want to talk about is another option that came to fruition this past summer. This is let me jump to that real quick. This past summer, the summer of 2022, the TSP made some modifications and they started a new program which is known as the mutual fund window. Okay, and what this option is it now gives people participating in the TSP, contributing, to now invest their money in funds outside of the TSP. Okay, so if there's something that you want to invest in outside of the TSP, this might be the way you want to choose. Okay, now there are some requirements. I know I'm just going to go through that real quick. Okay, the requirements are you have to, at a minimum, transfer at least $10,000 in your initial $10,000 or more in your initial transfer, right? So at the bare minimum, right, is $10,000. Secondly, you have to at least have $40,000 already in your TSP account. Okay, so if you have a minimum of $40,000 and you can only transfer over a minimum of $10,000, it kind of makes this last point here self-evident, right? You can't transfer more than 25% of your total account. So these are the dollars and cents and percentage requirements of using this option. Okay. Now, one of the other things is when you use this option, you're going to pay additional fees to use this option, right? And I lay those fees out here. $55 annual admin fee, $95 maintenance fee, $28.75 per share, per trade. And then all their associated fees, depending on what you're buying. If you're buying different investments, have different internal fees to manage those investments. But guys, if I'm gonna be honest with you, I really do not like this option. I really do, and this sounds like a very slanted statement, but I really do think this is a means of lobbyists in Wall Street trying to claw at federal government employees' 401k money. And the reason why I say that is because the options you already have in the TSP, although some people may think this is minimal, these are actually really, really good options. So more of a quality selection than quantity. You having 500 options, right? So I really like that. This mutual fund window, and the reason why I say that is, if you do want to invest in something that's not available in the TSP, in the normal funds, like let's say you want to invest your money in real estate, so there are other investment accounts outside, like IRAs and brokerage accounts that you can use to do that on your own as an American citizen and not just as a federal employee, right? So outside of your work accounts, all right? So that's why, and another reason why I say it is, look at the fees here. If you're not familiar with the fees in the finance world, these are exorbitant. These are over the top, right? $28 a trade? That's nuts. Most organizations out there, your Schwabs, your Fidelity, they call it the race to the bottom. Their trades are free, no charge at all. And again, that's what takes me back to the statement I made earlier about Wall Street trying to claw it, because those folks may not make money on the gains. They make money on fees and commissions. And just seeing this list makes it very blatant to me. And I'm gonna be honest with you, I work and help a lot of people understand the TSP, maybe even go online to MyPay and the TSP website to make changes. This is one of the things that is so blatantly bad. If you want to do something like this, you're gonna have to find someone else to help you, because I will not help you, right? I just don't think it's a good idea. I think it has bad motives. And if this is something you want to do, hey, I respect, a difference in opinion, but quite frankly, I'm not going to help you do it, okay? So I do want to make sure I educate you on this. I do want to show you the facts of this option because it is new and you're aware of it, but it's something that I would not recommend or help anyone that I love or in my network to help them do it, because I don't think it's a good idea, okay? So let's see, moving forward, kind of talked about this as far as investing in. So guys, one of the things, if I can go back to our options here, one of the things, and I'm coming to, and I live in the city of Las Vegas, and for most part, for some folks who have not really looked into and read some really good information on investing before, a lot of people only think about the bad stories their uncle told them, or their aunt told them about, hey, I invested all this money in the stock market and I lost it all and all of that. What I would recommend is get some education on it, some unbiased education, okay? And I could recommend some books. If you send me an email or you send me an instant message on Teams, I could recommend some books for you to read, maybe some lectures to listen to that are very objective and not from someone who's trying to sell you something. And the reason why that is, again, I mentioned I live in the city of Las Vegas. Some people even think investing is gambling, which is way off the mark, okay? Is, guys, when you are investing your money into maybe one of these funds or the L funds, I hope that you get yourself to a level of understanding of the investment, but also a level of understanding in yourself, okay? Because investing and buying these funds, I give an example of, it's kind of like choosing a mate to marry, okay? In that marriage or that relationship, there are gonna be ups, there are gonna be downs, right? You're gonna have good days, you're gonna have bad days, but if you continue that relationship, you continue that marriage, you're gonna have more good days than bad days. Right? And this is the stock market over time. This is the stock market starting back in 1872 all the way to actually past this year. This is a little bit of a projection right here. We're here today in 2022, creeping into 2023. Okay? And this is the United States stock market. Okay? As you can see, yes, there are some bad days, right? But for the most part, as you can see, especially for those of you that are hikers and like to climb hills and mountains, you can see that progressively things are going up. And if you invest in the stock market with a level head and with some education, right, you can worry about the bad days. Like, I'll give you an example, right? I tell people all the time, the smartest and wealthiest people in the world are not mathematicians, because you can calculate the percentage, you can calculate the compounding. But what really matters in investment is self-discipline and the habits that you have. Okay? Like, I'll give you an example. This is 1932 right here. This is the Great Depression, right? Breadlines, homelessness, unemployment that was horrible. Back in 2008, 2009, this was the Great Recession that many of you remember. Houses that were upside down on their loans. I mean, I remember back in the day, there were people committing suicide because they're foreclosing on their homes. Standoffs in houses and stuff like that. The economy was crashing, right? Back here, this is March of 2020 when COVID first hit us. The stock market for a month dropped 30%. People were scared, they're fearful. Everyone was out there panicking to buy toilet paper. And the reason why I'm bringing those things up is those are very emotional times. And if you're going to invest, you're going to invest in the C fund, the S fund, the I fund. I need you to know that although the value of your stock or your investment might go down, even though it goes down, you do not lose your money. Remember, you are buying shares, okay? You are buying shares, just like you buying a house or you buying a diamond, right? Some type of precious metal or jewels, right? Even though the value goes down, you still own the share. You still own the house, the roof over your head, or that diamond or whatnot. And so long as you don't share, that value will recuperate and actually go higher and higher and higher. The average in the stock market makes money up 8 out of 10 years. The question is, can you stomach the 2 years? Can you see this type of drop in the economy and just say, hey, yes, it's down, but it always goes back up, right? All those people in America getting up, going to work, working hard to sell products at Target, or Amazon drivers delivering packages, the people at Apple innovating new iPhones, right? Those folks, those folks coming to work to provide goods to Americans and people all over the world, provide services to people that are walking into hotels and restaurants. Those people are going to keep the economy going up. And we're some of those people, right? So again, it's one of those things I tell people, a good investment is like a good marriage. You got to love that investment in the good times and in the bad. And if you are buying an investment at the top of the market, but cannot stomach it to see it go down, then you have no business investing to begin with, right? Now, if you do not have that, what they call tolerance to that volatility, I think that tolerance and those nerves can be settled with some experience and some education. I tell people all the time, you come to my class, I'll tell you, I'll send this to you in an email, print this out and put it at your desk. So on the bad days, you know that things will get better. When things go wrong, they will recover. This too shall pass. So when things go down in a recession, just know, hang on, I'm not retiring tomorrow. And if I have some patience, I have some tolerance, I grin and bear, or maybe even talk to a friend who will talk you off the ledge, things will recover and they will continue to grow. Okay? If you want to talk to someone before you sell, because again, you only lose if you sell. If you sold your stock, your C fund, your I fund, your S fund down here, you lost. okay, you lost. But if you went down, the value went down. But if you held on to it and recovered, you actually made more money. So again, guys, it's something to think about. I know investing is not for everyone. And if it's not for you, I'm not judging you and saying that, something's wrong with you or anything like that. No, not at all. I want you to understand yourself and what can you tolerate. But I do think you can increase your tolerance, right? My gut checks were here during the Great Recession and here during the COVID correction when things went down 30, 40%. When those things hit and I was mentally preparing myself all the long time there, I was preparing myself. When those things hit and the market went down, I actually got excited, which is the opposite of most Americans. Because I know when things go down, now they're cheap. I went on to try to buy as much as I can, right? Warren Buffett, the famous investor, has an expression, is you want to be greedy when others are fearful, right? Meaning buy when everyone else is scared, right? And you want to be fearful when people are greedy. Because when people are greedy and things go up, they're likely to go down. So you want to make sure you're doing that, okay? Try to control those things. I want to see if there's anything else I have for you. I think that is it. This is just a pie chart of the S&P 500, the C fund. This is a different type of visual. So as you can see, it's fractional shares of all these 500 companies. The biggest fractions are in those large, powerful ones, the Apples, the Amazons, Alphabet, which is Google, Microsoft, Facebook, and then all these smaller fractional shares. You can't probably see this from the video, but you have all kinds of American companies in here. Cardinal Health, Wynn Resorts, Best Buy is there, Procter and Gamble, all kinds of companies are there. So that's just another visual for you, and that is what you're buying. With that said, guys, I hope these last 3 videos were helpful to you. This is not everything about the TSP. There are other things that are a little bit more in depth, and we cover more in our retirement classes, like TSP loans and so forth. But this is a class, hopefully I can make it as simple, as fundamental as I can. I encourage you to rewatch the video if you missed something. And I apologize for the length of it's a little bit long. I want to make sure I take the time necessary for you to understand. That's my priority. With that said, guys, if you do want to have a conversation, you do want to exchange some thoughts, or even a different perspective, this is just my opinion, my perspective. I'd love to hear how you see things differently. You can reach me via email. I'm at gregory.mesa2@va.gov. I'm also on Microsoft Teams if you want to chat, or like today, one of our physicians, we had a video call. And with that said, guys, have a great day.